to, instead of continuing on with the chapter 1, then I have to post it under chapter 1 and chapter 2. It's easier if I stop and start again and it starts a new recording for chapter 2. So we'll be good here, but the reason I'm a little bit hesitant, because I did want to show you something left over from this example. Um, so, because the way you see the discussion of the OCI question sometimes is they'll tell you that the beginning balance in the accumulated OCI was 100,000, and then they'll tell you that the company had a security like that security 2, in which there was a difference between the original price of $1 million and now the fair market value at the end of the year of 400,000. And so they'll ask you, what's the amount of other comprehensive income for the year? And so the answer is going to be what? The amount that brings it up to the 400,000 that's needed in there, right? Accumulated OCI has how much? 100,000. There's a beginning $100,000 balance. You need what? You need 400,000 in there. Therefore, your other comprehensive income for the year must be 300,000. Okay, so they do ask the question like that a lot of times. So I kind of showed you the way all this detail works back and forth, but just know that the adjustment for your other comprehensive income for the period is what is needed to bring the valuation allowance up to the balance that it needs to have, right? Not the valuation allowance, but the amount that goes into the marketable security account, whatever it has to be. And sometimes they do call that a valuation allowance. It's whatever you need to bring it up to the amount that's needed for the difference between what the original cost of the security was and what it is by the end of the year. Okay. Question on that? Okay. So just something I wanted to point out, because sometimes they ask the question that way. And I think we get more into that anyway in chapter 4 anyway. So we'll get some more practice with that. But in case you got a question like that on OCI in your homework. Okay. All right, good. Let's go ahead then. And let's jump ourselves to chapter 2. Now, it'd be nice if you really could say something about chapter 2, really truly fit it under a heading. But to a large extent, it is a catch-all of a lot of small little areas that made most sense to just group them all here in this chapter 2. Okay, so let's go ahead and let's just look at some of the potential point values, but really you're going to think we're at a basketball game, because what's going to happen? Everything is just going to be 2 points. Notes to financial statements, 2 points. Going concern, 2 points. A bunch of small areas, guys. Fair value measurement, 2 points. Segment reporting, maybe 4 points. I don't know, but not a lot there. SEC reporting, 2 points. Okay. Special for purpose framework, 2 points. Okay. Now, the only thing about this, they kind of trick you here. They call it special purpose framework, and then they don't say much more. The big deal here that they kind of ignore in the, what do you call this, table of contents, whatever, from this chapter, is the cash to accrual or accrual to cash. Okay, so what we'll see, for example, is they'll give me a cash net income. I have to turn that into accrual net income. They'll give me accrual net income, and I have to turn that into cash net income. That's 10 points, guys. I mean, there is a potential that they will ask you a task-based simulation, or they may ask you for a series of multiple choice questions. So what I have up on E-learning, okay, let me go back to e-learning for a second. Okay, what I have up on e-learning is the, one-stop shopping answer flashcard to that, because it's something that I'll explain a little bit of the logic behind it a little bit, but even after I explain the logic, your brain still goes, okay, huh? So unfortunately, you're going to have to flashcard this. You're going to have to nail this down to a flashcard, and you're going to have to follow that flashcard every single time. And again, I think this is one of those weightliftings that you do it enough times that you're finally like, okay, all right, finally this muscle has succumbed to this pressure I'm putting it under, and I can lift this thing. That's the way we're going to tackle that. So you may want to bust out that flashcard. I'll put it up when we get to that as well, but that's going to be the way to make sure that you don't get screwed up, where all of a sudden you get one of these cash to accrual or accrual to cash questions, and all of a sudden it's ruining your day because you were trying to follow some other things the way they present it, when at the end of the day you just got a flashcard and follow that flashcard to answer all the questions. Okay, ratio analysis, I'm going to put 5 points here, and then partnerships 2 points. Okay, so you look at this stuff, and for some reason I keep hearing in the chatter, so partnerships aren't on the exam anymore. I don't know where that chatter came from. That is not true. Partnerships are still tested on the exam. Partnerships are still tested on the exam. Partnerships are still tested on the exam. Okay. All right, good. Let's go ahead then, and let's take a look at this area here. Notes to the financial statements. I forgot my notes. Speaking of notes, I forgot mine. Okay, so let's go ahead and let's take a look at this first module, notes to financial statements. Now, there are a bunch of disclosures that have to happen in a set of financial statements, and we're going to talk about these throughout the discussion here, throughout the book, as we talk about when you need to disclose something for, we've already seen it, for other comprehensive income, for example, right? What this notes to the financial statements discussion is talking about is what constitutes that first or second note that you see in any set of financial statements, called the summary of significant accounting policies. Okay, and the nature of things that you see are discussion of things like measurement methods that they're using, the different types of accounting, what are their depreciation methods, what is their inventory pricing, etc. I'm not going to read all these because I think you get the sense of something that's summarizing accounting principles. That is the first or second note that you see in a set of financials. Now, we will talk throughout the course. Okay, my papers are going to stick together, it looks like. We'll talk throughout the course about different disclosures. Okay, hang on a minute, guys, because I apologize. I get all excited, and then when I get done with my class, I have a mess. So I want to organize a little bit here as I turn pages to keep them somewhat together. Okay. All right. So what happens? Throughout the discussion, we're going to see all kinds of different disclosure requirements. But what we're asking in this chapter is, do you know the nature of things that constitute summary of significant accounting policies? So you come over to the next page and they say the remaining notes to the financial statements, but that's a kind of backwards way of saying these are not summary of significant accounting policies. So what they'll do in a question is they'll give you a list where all 4 choices are good disclosure items, but only one of them constitutes a summary of significant accounting policy. Okay, we'll take a look at an example of a class question that we'll work together here in a minute. You'll see how they try to confuse you with that. Okay, now we also have to disclose risks and uncertainties. Okay, let's go ahead and let's talk about uncertainties first, since that's up here at the top. And so when you take a look at uncertainties, the uncertainty that they're talking about is the uncertainty associated with significant accounting estimates. So in any set of financial statements, there's that note that says, and I always liken it to the olden days on the side rear view mirror on the car, they'd say items in the mirror are closer than they appear. Okay, so that's telling you that's just an estimate. Don't pull out in traffic and kill yourself based on what you see there. Well, that's what the financial statements are saying. They have to have a note that says, look, there's estimates in here. We don't know for sure if these assets are going to last this long. We don't know for sure what the collectability of the receivables are. We're using estimates, and they warn users of that uncertainty. So it's estimation uncertainty. Okay. When we talk about risks, okay, what we're really talking about here, and that's down here lower, okay, when we talk about risk, we're talking about current vulnerability due to concentrations. So what happens? I have all of my subsidiaries in a particular part of the country. And if there should be some sort of unrest in that part of the country, some sort of war or something like that that emerges, then that would be a concentration risk that I would have to disclose. Now, what constitutes a concentration risk? Okay, so what happens? Concentration exists at the financial statement date. The concentration makes the entity vulnerable in the near term, and it is least reasonably possible that the events could cause severe impact. Okay, so that means that, hey, every time the wind blows, I don't have to talk about concentration risk, but if it's something that I'm vulnerable to, and it's reasonably possible that there'll be what? Severe impact, that's a key phrase, then I would have to disclose that. Okay, all right, good. Let's go ahead then, if we understand that now, and see what they ask us in this class question. I'll give you 1.5 minutes. I'll give you 1 minute on this one. Okay, guys, let's take your best shot on this one. I'm going to go ahead and end the poll here. And okay, a little bit concerning there. I mean, there's not a lot of point value here, but let's make sure that we're comfortable with this one. The correct answer is C, but only 60% of us got it right, so 59%, whatever. So let's take a look at this one. Which of the following information should be disclosed? And the key is summary of significant accounting policies. Well, refinancing of debt subsequent to the balance sheet date might be something that you want to disclose, but it is not a summary of significant accounting policy. Okay. Guaranteed of indebtedness of others, we have to disclose certain things about related party transactions, but that is not a summary of significant accounting policy. Adequacy of pension plan assets relative to vested benefits, that's nonsense. It's certainly not a summary of significant accounting policy, and I don't think they're going to make you make that would be really, that's on the playground of what we put into financial statements. We don't start assessing adequacy of vested benefit. That's nonsense. Criteria for determining what is a cash equivalent. Yeah, cash equivalent are those that have an original maturity of less than 90 days. If that's the case, you list it on your financial statements as a cash equivalent. And so on the balance sheet, where we're saying cash and cash equivalents, we would say see footnote number 1 or 2, summary significant accounting policies, and it would say in there the cash equivalents are those instruments that are so near to liquidity that they're equivalent to cash, which means they have an original maturity of less than 90 days. That's a summary of significant accounting policy type item. Okay. Okay, good. Let's come over and let's take a look at going concern issues. Okay. Now, when I look at this going concern, I get concerned, haha, that I wonder if the examiners might like to throw some questions like this on the exam, because we're coming off, hopefully, of the, the economy's hopefully going to be improving, but we're coming off of a tough time, and there may have been restaurants that were affected, say, by businesses like restaurants that were affected by COVID. We might actually have some going concern concerns now, right? So keep that in the back of your mind as you go through this, then yeah, maybe they would ask me something about how should we report about going concern. Okay, so what happens? Going concern consideration is something that's been around in auditing for a long time. Auditors were always supposed to look at their audit clients and determine if there was a going concern issue. FASB came out with this for companies here not long ago to say, you know what? Companies should be doing this work and disclosing information about potential going concern issues. So going concern issue is, hey, is the company potentially going to be going out of business? Just putting it in, very basic terms, be going out of business. Now, you look at this and you say to yourself, well, going out of business when? I mean, all companies eventually someday will probably go out of business, right? The companies that used to make, wooden, wheels out of stone for, Stone Age vehicles is out of business, right? So eventually every business will go out of business. Well, the answer to that, the time frame, is you only need to look into the next year. Okay, you don't have to look out, if you're an oil company and say, let's see. Yeah, I guess in about 10 years, these, electric vehicles, hybrid vehicles and everything will take over everything. And yeah, we're going out of business. No, you don't have to do that. It's in the next year, right? Okay, so let's just go ahead and take a look. We say under US GAAP, we presume that the entity will continue under a going concern, and the financial statement should be prepared under a going concern basis. If the entity's liquidation is intimate, then you should prepare financial information on a liquidation basis. So what's the deal here? Even if you think you have a going concern, you will still prepare the financial statements under the going concern assumption. It is rare. Liquidation has to be intimate. We're saying the next 30 days or something in order to use the liquidation basis. So something to get in our minds right now is that under the going concern disclosures, even if we have a going concern issue, we will still prepare the financial statements under the going concern assumption, not the liquidation assumption. Okay. Now, what is management's responsibility? And management is responsible to evaluate each annual and interim reporting period. Okay. Management evaluation should be based on relevant conditions and events that are known and reasonably knowable at the financial statement issuance date. You don't have to look out 10 years in the future and see what's going to happen with your business to do this, right? And what management's evaluation should consider both quantitative and qualitative factors. Quantitative is sort of a no-brainer, right? Hey, we're losing money. We're hemorrhaging cash period after period. There's a going concern issue. Two partners in a partnership can't get along. And there's just no way that they're going to be able to continue on like that. That might be a more qualitative consideration. Okay. Now, once management identifies a going concern issue, they can look to mitigating factors. Mitigating factors are things that cause the problem to go away, right? Mitigating factor. I am not feeling well. How will I mitigate my illness? I will take some medicine, right? So, what is some medicine that they can take to fix this going concern issue? Okay, so if conditions or events arise that there's substantial doubt about an entity's ability to continue as a going concern, we can look for mitigating factors that will alleviate the substantial doubt, medicine that'll alleviate your problem. Okay, now substantial doubt and going concern. I want to underscore those phrases because those are key words that you see a lot in the questions in this area. Okay. Now, once you look for things that'll mitigate that substantial doubt of the entity's ability to continue as a going concern, then you will need to look to see whether you can effectively implement that plan. So if you've got a company that's, you know, in danger of not having having substantial doubt of not being able to continue as a going concern, would you lend them money? So if the company says to you, well, we're going to borrow money, you know, they say, oh, we're going to borrow money, somebody could look at that, particularly an auditor, could look at that and say, you're not going to be able to borrow any money. Who's going to lend you money when you look at your financial condition, right? So it has to be something that they can effectively implement, and whether it is probable that the implementation plan will actually be successful, right? So they sit there and they say, well, our plan to get out of our cash shortage is to sell off all our assets. Well, yeah, you can sell off all your assets, but now how are you going to operate? Okay, so it has to be something that they can reasonably do, and it has to have the potential of being successful. Now, after you look at the potential of going concern issues and you look at mitigating factors, if there's no substantial doubt about the entity's ability to continue as a going concern, then no disclosure is required. Okay, notice substantial doubt is a key phrase here. If there is substantial doubt about an entity's ability to continue as a going concern, but you have these mitigating factors, then the substantial doubt is alleviated. Wasn't that an actor, Olivier? Okay. If if the substantial doubt is alleviated, okay, then you would have to disclose that, hey, we had this substantial doubt, but now we have identified these mitigating actions that we can take, and we believe that those mitigating actions will alleviate the substantial doubt. Okay, so let's flashcard this. No substantial doubt, no disclosure. Substantial doubt, but it's been alleviated. Disclosure, and explain how the actions, the mitigating factors that you're going to implement will alleviate that. If there is still substantial doubt, there's substantial doubt, and you looked for mitigating factors and they're not alleviated, I can't say that right. If there is substantial doubt and the entity's ability to continue going concern is not alleviated as a result of management's plans, mitigating factors, financial statements will continue to be prepared under the going concern basis. So even though you have a going concern issue and you don't think you're going to be able to fix it, you don't move to liquidation basis. You still prepare the financial statements under the going concern basis. And then here comes the footnote that then discloses, hey, there's substantial doubt, and you have to have that word in there, about the entity's ability to continue as a going concern. Okay. All right. So that's about it. Not too hard. Flashcard that. Okay. So what happens? No substantial doubt. Don't worry. Substantial doubt alleviated. Go ahead and disclose, right? Substantial doubt not alleviated. Disclose and call out that there's substantial doubt about the entity's ability to continue as a going concern. Those two phrases, substantial doubt and going concern. Okay. Question? Okay, good. Let's go ahead then and let's take a look at choice B. I didn't say that. You didn't hear me. Let's look at question 1. Okay, guys, let's go ahead and wrap this one up. I'm going to give you 10 seconds. Okay, looks like most of us have selected something at this point. Okay, I'm ending the poll. Okay, and good. 83%, that's a good percentage. Is it because I accidentally called out the answer? Okay, but let's look at this one. Okay, so you take a look and the answer is B. Okay, most of you got it right. Management has plans to mitigate conditions causing substantial doubt about the entity's ability to continue as a going concern. Our two favorite phrases here, right? Management believes those plans will be effectively implemented and successful in mitigating the adverse conditions. And you think back to the flashcard, which is what? Still got to disclose, right? It wasn't that there wasn't substantial doubt, there was, but it's been alleviated, it's been mitigated, so I'm going to still have to disclose, okay? Now, the financial statement should be prepared on the going concern basis and no disclosures. The only time I'm going to use liquidation basis is really if liquidation is intimate, and they're going to have to say that in the question. And really, they want to see, do you know, for going concern, you still prepare the financial statements using the going concern basis. But no disclosures. That's only if there never was substantial doubt. B, so A is not correct. B, the financial statement should be prepared under the going concern basis. Yeah. With footnote disclosures explaining the conditions that originally raised the doubt about the entity's going concern status. Okay, yeah, that sounded pretty good, but let's look at C. The financial statement should be prepared under the going concern basis of accounting with a supplemental schedule showing anticipated cash receipts. Okay, somebody had too much caffeine when they wrote that and started playing on the playground of what's required. The financial statement should be prepared on the going concern basis with a supplemental footnote information showing the balance sheet prepared under the liquidation basis. Somebody was having way too much fun. Now, when I look at a question like this, guys, this is a Becker prepared question. I can tell you right now, this was not something that was on the exam and then got released in this area. And I can usually tell because I am a person who has been asked to do a couple things. One, prepare multiple choice questions for Becker. And I'll tell you, after you write the correct answer, you start playing jazz with the wrong answers. And two, I've been asked to look at a section of the book and review material, including questions. And there are times where I'll come back and tell somebody, hey, you probably want to make the wrong choices a little less silly. So that looks like one of those questions. But the key takeaway from this is the way this one was very, very straight from the outline. That's why I had you flashcard that stuff. Okay. Okay, good. Let's go ahead then with that. And let's take a look at the subsequent events. Okay, now what happens here? There are two types of subsequent events. There's a subsequent event in which the conditions that gave rise to the subsequent event existed at the balance sheet date, okay? We call those recognized subsequent events, okay? The other type of subsequent event, there's two, are those that are non-recognized subsequent event. A non-recognized subsequent event, the conditions did not exist at the balance sheet date, but they arose after the balance sheet date, but before the financial statements were issued. Under those circumstances, GAAP expects us to disclose those. So when we say not recognized, that doesn't mean that it's not disclosed. It is still disclosed. Not recognized means there's not a journal entry for that. Okay, so let's just go ahead and let's look at the example here. Loss on uncollectible receivable. What happens here? We have a client. Sorry, guys, I tend to speak from the standpoint of an auditor. Let me speak from the standpoint of someone preparing the financial statements. John, we're in the FAR exam, okay? So we have a customer, okay? We're the company, we have a customer, and the customer declares bankruptcy on December 30th, Okay. Now that happened what? That existed on the balance sheet date, didn't it? Okay, or before the balance sheet date. So if you had a client that declared bankruptcy, what would you do? Your customer declared bankruptcy, what should a company do?
Write off their debt?
Yeah, wasn't that complicated, right? Debit the allowance, credit the account receivable, right?
Mm-hmm.
Who said that? Is that James?
Yes.
Okay, James, let me ask you this. Is that all you want to do? Don't feel bad, man. This is, life doesn't get much better than this right here. Someday when you're sitting there and you're older and you're sitting on a park bench somewhere and you look back and you'll say, man, when I was studying for the CPA.
I'm already older. That's why it takes me longer to figure these out.
That's what I do. When you see me sitting on a park bench, right? You see me sitting there, I'm sitting there going, man, CPA's it. Then the squirrels come and I talk to the squirrels and I say, hey, you squirrel, how do you increase an asset?
Awesome. Uncollectible receipts.
So what else you want to do? Have I stalled long enough for you? Okay.
Yeah,
The
real estate.
other thing you're going to want to do probably is debit bad debt expense
Yeah.
and put a little more in the allowance, right? Because now you know about something that hit against the allowance. So your estimating process might say, you know what, better kick in a little more into the allowance, right? But what you did is you just recognized a subsequent event by making a adjustment to the financial statements because the condition existed what? At the balance sheet date, right?
Income statement. Yes.
Yeah. Okay, now, and it hit both the income statement and the balance sheet, right? Now, let me ask you this, everybody, anyone can chime in. What happens if the client's customer doesn't declare bankruptcy until February 15th, and we're not going to issue our financial statements until March 1st? Did the conditions that caused that subsequent event exist at the balance sheet date?
No.
That's your gut reaction, right? And thus, thank you for playing, because no, that would still be considered a recognized subsequent event because nobody goes bankrupt overnight.
Mm-hmm.
So they're saying to us here, in the case of a loss on uncollectible receivable, the standards are telling you that existed at the balance sheet date, and that is a recognized subsequent event. Even though the company didn't find out about it until what? The customer didn't even declare bankruptcy until after the year end, but no one goes bankrupt overnight. So that must have existed at December 31st, right? That's been coming. Okay. Now, if we had a lawsuit in place and that lawsuit was already filed and whatnot, and then we don't find out until after the balance sheet date, but before we issue the financial statements, that there's been a settlement on that, and let's say we lose the lawsuit, then we would debit loss and we would credit what? Contingent liability. Because again, that lawsuit existed at the balance sheet date, even though we didn't get the full outcome until after the balance sheet date and before we issue the financial statements, then we have to make that adjustment. Okay. Now, let's say we have an accident and one of our plants blows up, and our plant blows up in February, and we're not going to issue our financial statements until March. Do we have to recognize that? No, because the plant didn't blow up until what? Until after the balance sheet date. We didn't know it was going to blow up at the balance sheet date. It didn't blow up until after the balance sheet date. So even though that is not going to have to be recognized, it will still have to be what? disclosed.
Yeah.
Okay. Okay, good, good. So two types of subsequent events. Okay. And I want you to go ahead and flashcard. Okay. The definition of those. Recognize subsequent events, provide additional information about a condition that did what? Existed at the balance sheet date. Bankruptcy and a writing off a client and loss on from a settlement of a litigation are specifically called out in standards as things that are recognized subsequent event. So you got to remember that. Okay. Whereas what non-recognized subsequent event, the second type of subsequent event, you may want to make yourself a flashcard that kind of says what are the two types of subsequent event, recognized and non-recognized. How do you handle recognized? You make an entry in the financial statements. How do you handle, that's how you handle recognized. How do you handle non-recognized? Disclose. Okay. Okay, good. Now come over and some, annoying stuff. SEC says that you must evaluate financial statements through the date the financial statements are issued. All other entities must evaluate subsequent events through the date the financial statements are available to be issued. Okay. They tell us that financial statements are available to be issued when they are in the form and format that complies with GAAP and all approvals have been attained. Sorry, guys. I just want you to have that on a flashcard. I know that's annoying. And then if you have to reissue financial statements, so what happens? Let's say I made an error and I realized that I made the error in April. And so I reissued the financial statements were originally issued in February, and now I reissued them in April. Do I need to look for subsequent events between February and April? And the answer is no. Okay, when an entity reissues financial statements, the entity should not recognize events that occurred between the date of the original issue and the state and of the original financial statements were issued or available to be issued and the date the financial statements were reissued. Say all that 10 times fast. So you don't need to look for, subsequent events that happened from the date of the original issue to the date that they were reissued. Okay, flashcard that. Question on that? It's a little sing-songy. Okay, good. All right, so let's go ahead and guys, you can see that we're kind of flying along here, and I'm doing that because you can see it's quick, boom, boom, short hit areas that we keep going through here, right, in this chapter 2. So let's just go ahead and let's take a look at this particular question. Okay, and I'll go ahead and relaunch the poll. I'll give you a minute and a half on this one. Okay, I'm gonna wrap this up. Make your choice only if you think you have the right answer. No, I'm just kidding. Go ahead and make your choice. Okay, and let's take a look. All right, so yeah, I would have hoped that more of us got this right. Okay, and so what happens? This either is a recognized subsequent event or a not recognized subsequent event. Recognized subsequent event, what happens? It means that the conditions existed at the balance sheet date, and therefore we'll have to do what? Accrue, and we will have to, of course, you always have to disclose about a subsequent event. Maybe I should have pointed that out. Accrue and disclose. I mean, you just don't accrue something and not disclose it. So if it's a type 1, you accrue and disclose if it's a type 1. If it's a recognized subsequent event, if it's a non-recognized subsequent event, you just disclose. But when we look at this, they tell us that they settled in year 2 for an event that occurred in year 1. They'd made an estimate of a liability in year 1. So clearly the conditions existed at the balance sheet date. And if before you issue the financial statements, you actually settle, well, erase the estimate and put the actual settlement amount in, right? And so you will make both a disclosure and an accrual. Okay, it's not disclosure only. You might have picked B because maybe I didn't make it clear enough. I don't think I did, that even if you make the accrual, you still have to disclose what you did. And I don't know, it's clearly a subsequent event, and there were no subsequent events for which you don't have to disclose something. Notice they gave me the phrase in here that it was material. What would have happened if the question didn't call out that it was material? This question called out that it was material. What if it didn't? Same answer. Don't sit there and say, well, is it material? If they don't tell you it's material, assume it's material. They have to tell you it's not material in order for you to assume that it's not material. If they don't say anything about materiality, you assume it is material. Okay. Okay, good. Let's go ahead and let's take a look at module 4. Okay, let's look at fair value measurement. Okay, what's going to happen? There are certain items in our financial statements that we'll have to report at fair value. For example, we've already talked about a little bit, marketable securities get reported at fair value. How about our property, plant, and equipment? No what? Historical cost, unless there's been some kind of impairment, which we will write it down to a lower fair value. But things like marketable securities are reported fair value up or down, right? Okay. So what FASB did is they said, okay, what we're going to do is we're going to sit here and we're going to give you some tools now to help you measure your fair value of things that are actually measured at fair values. Not everything, but things like financial instruments, etc. Okay, so fair value is the price that would be received to sell an asset or pay to transfer liability in an orderly transaction between participants and the principal, or if there is no principal, most advantageous market. Okay, notice here, guys, that they say an orderly transaction. Okay, what do we mean by orderly transaction? Housing crisis 2008. Which crisis? So I'm having trouble keeping track of them these days, right? Housing crisis 2008. People got into these mortgages where after a while, a payment that was $2,500 a month became a payment of $5,000 a month, $7,000 a month, more than they made. Do you think those people were selling their homes in an orderly transaction? No, they were just trying to get out from under, right? Okay, so that's not the kind of thing that we're talking about. With an orderly transaction, you have time to do what? Have time to market the item. You have time to take different offers. You have time to get the best price, etc., for that thing that you're selling, right? That's what they mean by an orderly transaction, okay? Or a orderly transaction, okay? So again, next page, orderly transaction, okay, and I probably should have flipped to this already before I gave you the example, means there's time to market it, go through the usual customary activities, put the thing on the market, clean up your house, all that kind of stuff, right? Not a fire sale, okay? Now, when you come over, they tell us that the market that we should use to determine the price should be the principal market. The principal market is the market with the greatest amount of activity, okay? If the principal market for an asset where the market will be the fair value measure, if there is a principal market for an asset or liability, the price in that market will be the fair value measurement, okay? And they tell us that even if there is a more advantageous prices in a different market, okay? So again, your principal market is the market in which you have the most activity, okay? And you must have what? Access to that principal market. So just go ahead and flashcard all of that, guys, okay? Principal market, the most activity. Even if there is a more advantageous market, you stick with your principal market where you have the most activity, but to use that principal market, you also have to have access to it, okay? Well, if that's the case, then when do you use the most advantageous market? And the most advantageous market is the one with the best price, okay, after considering transaction costs. And note that although transaction costs are used to determine the most advantageous market, transaction costs are not included in the final fair value measurement. See example, we will. And when you see that example below, you will totally understand it. And then the price of this most advantageous market will be fair value measure only if there is no principal market. So what's the rule? Use the, what are the rules? Use the principal market, right? But if you don't have a principal market, you do what? Use the most advantageous market. How do you determine most advantageous market? By the best price after you consider transaction costs. That's how you determine most advantageous. But when you report fair value, you don't consider the transaction cost. Let's look at the example and you go, okay, I got it. All right, I know that's a little tough right now. Just look at this example. Quoted price, New York, London. Which one is the more advantageous before you look at transaction costs? Looks like New York. But when I consider transaction costs, now what? London is the most advantageous market. Now look, if my principal market was New York, I just use New York. If my principal market is London, I just use London. If there is no principal market, I use the most advantageous, which is London here, but the fair value I report is not 48, it's 50. So I use the transaction price to figure out my most advantageous market, but then I report without considering the transaction cost. Okay? Okay, good. Beautiful example. All right. Now you come over and you take a look at this example here. If it's a non-financial asset, such as equipment or something like that, fair value measurement of non-financial asset takes into account the market participant's ability to generate income using the asset at its highest and best use. Okay, and the highest and best use could be selling it to another market participant. If that's its highest and best use, so be it. Or its highest and best use is using it, then you would look at it that way. Flashcard that. A reporting entity's current use of non-financial asset is assumed to be the highest and best use unless market or other factors suggest a different use by market participants would maximize the value of the asset. Okay. Liabilities and financial assets, the highest and best use concept is not relevant when measuring fair value of financial assets because the items do not have alternative uses and their fair value do not depend on their use within a group of other assets or liabilities. Okay. All right. Just a little bit of detail there. Now come over, and what are going to be some techniques that I can use to measure my fair value. Okay. And so what happens is I can take some different valuation techniques. And these valuation techniques, guys, come right out. I could pick up, I don't think I have one anymore. I used to have an appraisal book. I could pull one of my old, if I think I threw them out now, but I used to have some books about how to do appraisals. I got put on an assignment where Congress was asking us to look at how reliable were appraisals on commercial real estate, because the appraisals on those commercial real estates would be then determining value. And the concern there was that if the appraisals are shot, the valuation is shot, and maybe lenders, banks, right, aren't putting enough into their valuation allowance for these commercial real estates. So here I go. I got a book on appraisals that I looked at, and that comes, these approaches to valuation technique really come from appraisal language. So you can use a market approach. With the market approach, you'll basically look at comparable assets. That's what a lot of appraisers, and sometimes it drives me nuts when people appraise my house and I'm trying to refinance or I'm trying to sell a house or something, you have to get it appraised. And they sit there and they say, well, your house is worth this. And then they looked at four other properties. My house is built in 2017, and the appraisal difference, they're looking at houses built in 1908, and they say, well, that house is comparable. No, it's not. Okay, but sometimes that's how they do it. They use this market approach. Okay, you could use an income approach. An income approach is basically going to convert future income into cash flows, discount the cash flows. That's the value. Okay. Cost approach says, what would it cost you to replace that? Okay. I think a lot of times, they use that market approach because it's so easy. They just go and they take a bunch of pictures of supported comparable properties or comparable assets, whatever, and they feel they've done something. Okay. Now you come over and we have inputs that we need to consider. Okay. And these inputs that we should consider are first level one. If we don't have level one inputs, we consider level two. If we don't have level two, we're stuck with level three. Okay, so you start with level one. Level one inputs are quoted prices for identical assets. So if you've got a stock and that stock is publicly traded, you've got a level one input. It's an identical asset. It's just different shares that you have versus the shares that someone else's hold. But whatever the quoted market price is on those shares, that's a level one input. You're done. If there are no level one inputs, let's say you hold some sort of security, but it's not traded, it's not actively traded on any one of the markets, what would you do? Well, then you could look for what? Quoted prices of similar items and say, okay, that's a reasonable substitute. Since there are no level one, I'll use level two. Okay, you don't have level one, you don't have level two. Your last resort is what? Level threes, and you look at unobservable inputs reflect the reporting entity's assumption and should be used as a best available information. And you only use level three when there are no observable level one or level two inputs. Okay. All right, good. Flashcard that. So just a listing of things that you would consider. And let's just go ahead and take a look at some fair value disclosures. Okay. And let's just look at some of these things down here, right, that should be disclosed about fair value. And let's flashcard these. Quantitative information, discussion of sensitivity, level 3 to changes, information about non-financial assets that differ, for which measurement differ from the highest and best use, hierarchy for items that are not measured on the balance sheet but are disclosed in the notes. Okay. All right, good. Let's look at this example here. And we have this during the year. Marker 8 company purchased 3,000 shares of Mileage Inc.'s common stock at the time of the purchase. The stock was trading at a price of $24 per share. The quoted price for Mileage Inc. at year end, according to the public exchange, was $21.50. Okay, I don't even know why I'm looking at this example. I mean, what is the point here? Okay, I'm just going to sit there and compare the difference, and it's a quoted. I guess they're trying to tell me here to look at level 1 inputs, and yeah, okay, great. I mean, whatever. Question on this? That just seems so simple and so basic. I'm not even sure why I'm looking at it. Okay, all right, let's go ahead then and let's try a multiple choice question. Let's do that. Okay, ready? We're about 1:30, so take your best shot, okay? And let's go ahead and let's look at this one, okay? All right, good. So most of us got it right, 70% of us, okay? And they want to know what we should report at fair value. What fair value should we report? And the answer here is C, but let's take a look at this one. And we've got what? We've got New York, we've got London, and there is no principal market. No principal market, I have to use what? Most advantageous after considering transaction costs. So New York wins as the most advantageous, but when I report what? I report without considering the transaction cost. Okay. All right, good. Let's go ahead and let's jump to module 5. Okay. And let's take a look at segment reporting. Okay, now what happens here? All right, so you have a set of consolidated financial statements. And when you look at a company consolidated, you're taking different segments, maybe their Eastern segment, Western segment, their European division, their, product A, product B division, and you're consolidating them into one big giant company, right? Now, what happens? Does the CEO look at the company that way? No, the CEO is going to have what? They're going to look at segment information so they can evaluate to what extent these different segments are contributing to contribution margin, to profitability of the company, whatever, right? So what happens? FASB says, well, look, CEO, you have information that could be useful to our investors. You've got to potential investors and creditors. You've got all this stuff sitting on your desk. You need to share that stuff. And so the CEOs go, I have to share everything that's on my desk. And FASB says, no, just the big stuff. Okay. So what happens? That image should be help you with the point of that image is to help you with the two major takeaways, which is what? We don't have to create new information for our segment reporting. It's information that the entity already uses in running the day-to-day operations. And we don't have to report everything we have. We have to report what? Things that meet a certain size test. And we're going to talk about these size tests as we go forward. Okay. But let's just go ahead and see that what we're doing is we are trying to help who with this segment reporting? Help users, right? Get a better look at what's going on with this company. Okay. Now, this is something that is required for public companies. Okay. So public companies have to provide this information, and they have to provide segment information about operating segments, geographic segments. There's no qualitative description of what you have to provide these for. It is more of a size thing. Now I say there's no qualitative. There is, well, let me point out a couple things here. You don't use different accounting for your segment information. Whatever the consolidated statements use, that's what you need to use to report your segment information. And we're going to see that when we report the segments, if there is intercompany transactions, we do not eliminate them. We want our users of the financial statements to see these segments as though they were standalone entities. So we do not eliminate intercompany transactions. Okay. Flashcard, those couple of things. Okay. And then come over, and we've already said it's public companies. But let's see what we mean by operating segments. And the definition of a segment depends on how management uses the information. Okay, so again, there is no requirement that you develop some specialized segment information. It's stuff you got. The question is, what is going to be big enough to be reported? Okay, now I said there's no qualitative as to what is a segment, because it's a purely numerical size test that we're going to go through, but there is sort of qualitative considerations of what is not a segment. And so pension plans are not a segment. Corporate headquarters is not considered a segment. So you're not going to have to report these pieces like pensions and corporate headquarters as segments. They're just taking those off the table. Okay. So if that's the case, and I'm reporting operating segment, what makes a segment big enough to report? And the answer is size tests. There are size tests. Next page. Okay, these quantitative thresholds. Okay, size tests. What's big enough to have to be reported? Okay, now you come over to the next page, and flashcard, the size test. There are 3 10% size tests. If you don't meet one of the size tests, then you could meet the other one of the other size tests, and then you would have to report that as a segment. Okay, so it's not like if you fail one of the size tests, you're done. You have to go to the next size test to see if that segment is big enough to be reported. They're all 10% tests. One is revenue, one is reported profit or loss, one is assets. So what do? We start, let's talk about the revenue test first. And you don't have to do them in any particular order. We're just talking about revenue here first, but a company just has to meet any one of these size tests. You don't have to meet all 3 of them, any one of these size tests, and you have a reportable segment. So the segment's revenue, including both sales to external and inter-segment sales, okay, basically is 10% or more of the combined revenue, then you have a reportable segment. So what are you going to do? You're going to add up the revenue of all your segments. Multiply that number by 10%. Any segment that has revenue that is greater than or equal to that 10% of the total is going to be reported as a segment. Now, if you don't make it on the revenue test, then you might make it on the asset test. So now I'm going to do what? I'm going to take all of the assets of all of my segments, add them together, multiply that number by 10%. Any segment that has assets that are greater than or equal to that 10% number is a reportable segment, even if it didn't make the revenue test. You only have to meet one of these tests. Okay. Reported profit or loss. What am I going to do here? Well, now I'm going to group all of my profit segments together, add up all those profits, and then I'm going to take all my loss segments and group them together and add up all those negative numbers and come up with that big negative number. I will multiply the bigger of those two numbers, either the profit number or the loss number, by 10%. And any segment on an absolute value basis that has a profit or a loss greater than that, equal to or greater than that 10% number is going to be a reportable segment. Okay, so these are the 10% test. You understood the revenue and the assets, and for the profit and loss, you wouldn't say what. So what I want you to do is just put MCQ, multiple choice question, 0, 5, 0, 5, 5, 0, 5, 0, 5, 5, 0, 5, 0, 5, 5. Okay, and probably by now I lost my Becker. Okay, so let me go ahead and find that, which means I need to do this, and I need to do this, and I need to say, please God, don't mess anything up when I come out of tablet mode. Asking God is a good idea. Okay, I have to sit here and sign in. I have to go to this little magnifying glass, and I have to type in 0, 5, 0, 5, 5. Is that the number I told you? Okay. Yep. And then I go ahead, and here's the question I wanted to show you. Okay. And I forget the answer, guys, and I don't care. Okay. I just wanted to show you the answer. Okay. So let's look at this question. So we've got this Astor, and we've got this B. Jackson, Carter, and Davis and Elbow, and they're giving us their each of their respective incomes or losses, right? They give us the eliminations as a distractor. Remember, to determine we have a reportable segment, we don't worry about eliminating intercompany transactions. So we just look at the total. You don't worry about eliminations. Okay. So Astor at 215, that's a positive number. That was net income, positive profitability. We put that in the positive column. BJax was 30. Carter was a loser, 180. That goes in the loss column. Davis was 80. That goes in the income. And then Elbow was a loser of 20. That goes in the loss column. We add up our positives, profits. We add up our negative losers. And when we do, 325,000 on an absolute value basis, and a real basis, I guess, is bigger than what? 200,000, right? So I take that 325,000 times 10%. My threshold is 32.5. Now I go through and I look at each one of these to see if on an absolute basis they have a number that exceeds 32.5. So 215 versus 32.5, yes. 30 is less than 32.5. 180 on an absolute value basis is bigger than 32.5, so that's a reportable segment. 80,000 is bigger than 32.5, so that's a reportable segment. And 20,000 on an absolute value basis is less than 32.5. So that's a no. So my three segments here are Astor, Carter, and Davis was the correct answer. Astor, Carter, and Davis, choice D. Okay. Okay, good. That's all that's going on there. So I show you that question because I don't know, you look at the outline and you're like, what the hell is profit or loss and absolute value? That's what they're talking about. Okay. All right, good. So let's go ahead, gently put me back in tablet mode. Please, God, don't destroy anything. Okay, and let's go ahead and let's take a look at the 75% reporting sufficiency test. So after you've gone through and you have considered the 10% test and identified your reportable segments, you have to see if you have enough reportable segments. And so you're going to have to see if the segments that you identified using the 10% test now have constituted 75% or more of the consolidated revenue of the company. And if they have, you're good. If you find yourself below 75% of the consolidated revenue of the company, now you have to add segments until you get up to at least 75%. And there is no rule as to how you add segments. They don't tell you take the next biggest one. They don't tell you take a bunch of little ones to push yourself over the 75%. And so it gets tough for a CPA exam question to test, do you understand that you have to add segments once you get below 75, if you end up below 75%, unless I guess maybe they give you a problem in which there was one segment that didn't meet the 10% test, but only that segment will bring you up over the 75%, then you're going to have to include that segment too, even though it failed the 10% test. Okay, so if the total of external consolidated revenue constitutes less than 75% of the consolidated revenue, you have to add segments until you get up to at least 75%. And again, the way I could see the examiners testing that is the segments that you didn't include based on the 10% test will have to be included in order for you to meet the 75% test. Okay, so with that, okay, I want you to come all the way over to page 26. Flip, 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 guys. I mean, they start giving you a lot of extra stuff here that I do not think brings much light to the subject for you. Okay, and I just want to look at this question. Okay, and I'm gonna do this one together with you. Okay, so this one, they tell me in conformity with the revenue test, what are the reportable segments? Now write out what's the first thing I have to know. Well, maybe you're not able to read my mind. The first thing I have to know is what? I gotta know that the revenue test is a 10% test. If I don't know that, I'm screwed. I'm done. I can't answer this question. Okay. The second thing I have to know is what? I look at total revenue. I don't look at the consolidated revenue. I don't worry about the eliminations, right? I look at total, both inter-segment and unaffiliated sales. So I need to pick up that what? 83,000 number, and I need to multiply that by 10%. There's my threshold, 8,300. Now I go through the segments and see if I have any that exceed that threshold, right? So does Allo exceed 8,300? Yes or no?
No.
Oh, good. Does Bix?
Yes.
Bix does. Does C?
No.
No. But what? Dill does. Okay. So my what? My reportable segments are Bix and Dill. Choice B. But do I have enough segments? Remember, I'm stuck with that 75% sufficiency test, right? So what they tell me is, well, you have to then look at the consolidated revenue of those segments you identified doing the 10% test, which is our BIX and DIL. BIX is 12, DIL is 59. 12 plus 59 is
71.
Yeah, but that's not what I wanted because I looked at the total. Sorry, guys, I looked at the total and I need to look at what? I need to look at the consolidated. That's what's to unaffiliated. So BIX is what? BIX is 8 on a consolidated basis, what was to unaffiliated. And DIL was 43. Sorry, guys, I did that the wrong way for a second there. So 8 and 43 is what? 51,000? I take 51,000, I divide it by what? 60,000 consolidated revenue, and I get 85%.
So you met the 75%.
Good. I meant the 75% threshold. I'm good. I don't have to start adding segments to try to throw me over the 75%.
Thank God.
Okay. All right. Okay, guys. SEC reporting. I am going to ask you to look at that on your own. I know that, you know, you'd rather maybe have me talk about it, but I'm telling you now, this is not worth our time because it just becomes a long listing of things that SEC requires companies to report. You don't need me to read to you, okay? So you can either read it on your own and look at it, get comfortable with it, or you can review the lecture that Becker has. There's a lecture for each module if you want to look at that. But I don't want to spend the limited time that we have together reading to you, okay? And that's really what all that becomes, is a listing of you got to report this, you got to report that, okay? So I want to jump us, okay, to module 7. And I want to start to take a look at these special purpose frameworks, okay? Again, it's a listing of forms and things that have to be reported. We've got bigger fish to fry here, okay? So let's see what we can do with the special purpose frameworks. Now, what happens here? Companies sometimes have to prepare financial information and they're not going to follow GAAP, okay? For example, let's say I'm an insurance company. And as an insurance company, I am supposed to report information to my state insurance commissioner, and there is agreed upon accounting for an insurance company. For example, the National Association of Insurance Commissioners says that when an insurance company prepares their financial statements to report to the insurance commissioners, under statutory accounting practices, don't put office equipment on your balance sheet. They're saying we don't want to sit here and muck up the viability of an insurance company for insurance commissioner evaluation with things that are almost nothing like office equipment and whatnot. So it's a little bit different than GAAP. Yet I am required to prepare financial statements following the National Association of Insurance Commissioners requirements for filings with the state insurance commissioners. There is no national insurance commissioner. Insurance companies are regulated at the state level, but the National Association of Insurance Commissioners recommends the accounting standards that should be used to file with the insurance commissioners of the various states, okay? Well, that would be an example of a special purpose framework. Or maybe I'm a small mom and pop grocery store or something, I don't know. And I don't need a full set of accrual financial statements. So I'm going to prepare my statements using the cash basis, etc. Okay. Well, that's okay. You can do that. Of course, you can't be listed on the stock exchanges that way, but you may want to prepare your financial statements following a special purpose framework. Okay. Now, here's the big takeaway. You can't call the financial statements by the GAAP titles. The balance sheet, the term balance sheet, right, is reserved for a set of GAAP financial statements. The term income statement is reserved for a set of GAAP financial statements. Okay. You say, oh, okay, so what are we going to call it? Just don't call it the balance sheet. You can call it the, assets and liabilities arising from transactions. You could call it balance sheet cash basis, but you can't call it balance sheet. You could call it revenues collected and expenses incurred, but you can't call it the income statement. You could call it income statement cash basis, okay, but you can't call it an income statement. That's the big takeaway here, okay? So let's just go ahead and notice that you can sit here and prepare financial statements using the cash basis, using tax basis, right? Okay. Or some sort of regulatory basis. Again, that example would be if you're an insurance company and you're filing your financial statements with the insurance commissioner, you'd follow the National Association of Insurance Commissioners standards, and you wouldn't include certain certain office equipment, certain assets on your balance sheet. You don't call it a balance sheet though, okay? So what happens? Titles, okay? Titles should be different from the accrual basic financial statements. In other words, don't call it a balance sheet, call it balance sheet cash, call it income statement cash, but you can't call it balance sheet, you can't call it income statement because they're reserving that for what? They're reserving that for the GAAP financial statements, right? The required financial statements are the equivalent of the accrual basis balance sheet and income statement, but don't call it that. The financial statements should explain changes in equity accounts, and a statement of cash flows is not required. And then there needs to be what? There needs to be disclosure in the other comprehensive basis, cash basis, that these are not GAAP financial statements. There needs to be a summary of significant accounting policies, and the big thing being, hey, these are cash basis financial statements. And then they do say to you, and you know what? Make the informative disclosures that you would make if they were GAAP financial statements, okay? So big thing, don't call it balance sheet, don't call it income statement, okay? No statement of cash flows, okay? And what? You need to disclose that you're using something other than GAAP. And if there are other disclosures that would be relevant, you should disclose those, okay? Okay, now you could use cash basis, okay? You're not required to use, you could use the cash basis, but they do give us a little, guidance here, and they say, hey, don't use cash basis for complex entities. We're really talking about what? We're talking about entities that aren't terribly complex if you're sitting there using the cash basis. Okay, now you come over, every time I say that, I think about a former student of mine who works for a trust, a family trust, and they use cash basis, and she would probably cringe if she saw me saying, well, if it's complicated, don't use cash, because she's got some complications in some of the things she has to do. But they're talking about, you don't have a lot of subtle accruals and that sort of thing that need to be done, right? Okay, now what happens? Under the cash basis of accounting, revenues are recognized when cash is received. Expenses are recognized when cash is paid. Okay, and again, they tell us things like estates and trusts, okay, are entities that probably would use that cash basis. All right, now you come over, and statement of cash and equity is like the balance sheet, but we don't call it the balance sheet, right? And in the pure cash financial statements, the only asset is cash. There are no liabilities are recorded because you haven't paid them yet. Therefore, they're not there to be reported because you haven't paid it. There is no such thing as a liability. Liability is a bill that you haven't paid yet. And if you're only reporting something after you disperse the cash, there's no such thing as a liability. So all you have is cash as an asset and what? Equity, okay? Then what? Your statement of receipts and disbursements is like the income statement. See how we get wordy when we can't use the GAAP terms? But you're going to have what? Revenues received, debt and equity proceeds, proceeds from asset sales, expenses paid, debt repayments, dividend payments. Anytime you dip into your cash, that's going to be listed as either, or receive cash, that's going to be listed as a receipt or a payment. Now they do have modified cash basis. And if we're talking about a modified cash basis, then there are certain modifications that you'll make to the cash statements, okay? Such as, and you can go ahead and flashcard these, such as capitalizing and depreciating assets, accrual of income tax, recording long-term liabilities and short-term borrowing, capitalizing inventory, and reporting investments at fair value and recognizing unrealized gains and losses. Just flashcard that. These are modifications if you're going to use modified accrual. Okay, let's take a look at, again, the names of the statements. Statements and liabilities, modified or cash basis arising from cash transactions. That is the way to say the balance sheet, statement of revenues and expenses, retained earnings, whatever. That is what?
Income statement.
Income statement. Just don't call it by those names. It's like, let me put the word like. Okay. All right, good. Okay. Income basis financial statements. Fine. Just use the tax rules to prepare your financial statements. Okay. They're prepared based on methods and principles used to prepare a tax return. So now what happens, you may show as an expense something that you're able to write off on your taxes that you would have capitalized in your business, right? Okay. And then again, don't call it a balance sheet. Don't call it an income statement, whatever they're saying there. And you can play jazz with what you call it. Just don't call it the balance sheet. Don't call it the income statement. So it's not like you have to memorize what you do call it. You have to remember what you don't call it. Okay. All right. What are we going to do here? Yeah, I think we've got time to go through converting cash basis to accrual and then converting accrual basis to cash. Okay, and as I said in the introduction, this does have the potential to be heavy on the exam. Okay, so what I'm going to do is, because I just don't like the way the book has presented the material here, and so I'm going to give you that flashcard that I talked about, and then we're going to practice the problems here together. Maybe I'll let you do one on your own, but we'll practice a few of the class problems that they give us here together, seeing if we can use that flashcard to get to the right answers for these, okay? But let me just stop for a second, okay, before I roll straight into that flashcard. And let's say I'm preparing my financial statements and I'm using the cash basis, okay? So I have year one. And let's say that I provide revenue, provide service on account receivable. What journal entry should I make on the cash basis? So I provide the service, the person hasn't paid me yet, and I tell them, okay, I'm going to bill you, and they don't pay me until year two. What journal entry should I make in year one?
There's no cash exchanging hands yet, right?
Correct.
No entry.
Good. I'm not going to do anything.
Yeah.
No entry. Like they put in front of the restaurants right now, right? You can't go in. No entry. There is no journal entry that's made because no cash was received, right? Okay. So when I prepare my income statement, I can't call it an income statement. My income statement cash basis for year two, right? Do that again, John, and you're going to turn into a gas. Okay. So what happens? I sit here and my revenue is 0. My expenses are 0. That was the only transaction. I provided that service and I'm going to bill them next year. So my net income is how much? 0, isn't it? Okay. Now, if I want to sit here and turn this into what? Turn this into cash basis. I would sit here, I mean, excuse me, that was cash basis. I want to turn it to accrual basis. I would do what? I would start with my net income on the cash basis, which is 0, right? And then I would look at my current assets and see if they changed. And what happens? My revenue did what? My revenue, I mean, my accounts receivable did what? My accounts receivable increased, didn't it? And let's say it was $1,000. I don't think I gave a dollar amount. Let's say it was for $1,000. I would add the increase in that current asset in this case being what? Accounts receivable. I would add that and I would get my cash net income. I mean, I would get my accrual net income, and my accrual net income would be what? Would be $1,000, wouldn't it? So I'd look at my current assets, and if they increased, I would add them, and that would give me what? That would give me my accrual net income. Now, if I go into year 2, and now year 2, I collect that $1,000. So in year 2, on the cash basis, I'm going to do what? Debit cash, 1,000, and I'm going to credit what? Revenue for 1,000. And when I look at my income statement, cash basis, then I would have what? I would have revenue of 1,000. I would have expenses of what? Of
0.
0, just on the fact pattern that I'm giving you. And my net income on a cash basis would be 1,000. If I want to turn that into accrual, I would do what? Again, start with my cash net income, which in this example was 1,000. And then I would look at my current assets, and when I say look at the current assets other than cash, I would look at my current assets, account receivable, and what happened? My account receivable would have gone down, right? It was 1,000, but now it's what? 0, because the person paid me. So I would subtract the decrease. And when I subtract the decrease, I get what? I get my accrual net income. And my accrual net income was what? Was 0, right? Because I only collected cash in year 2 from something that I had done last year. Okay. So this is the logic, all right, that generates this flashcard. And the reason I'm taking this flashcard approach with this stuff, guys, I don't give a damn how well you understand what I just said to you or not, because you get into a question and your mind starts going buzz. I don't care how many times you looked at this, you get into the question, you're like, oh my God, what is going on here? So this is one in which we're going to put a flashcard on it. And we're going to use that flashcard every single time we work one of these stupid questions until we get better and better at using this method. And I promise you, you use this method enough times on this flashcard, and all of a sudden you'll go, I got this. I even understand what I'm doing now. I got it. I see what I got to do here with these questions. And that's where we want to be for the CPA exam, right? So let's go ahead and let's look at that flashcard, which is on e-learning. It's called the cash to accrual but also, oh, okay, yeah, I did a very good job. Cash to accrual, accrual to cash. It's got both because questions could go either way. Okay, so I just want to go ahead, let that open up. Okay, and you can see it on the screen right now. Okay, and let's just take a look. Okay, so if I want to go, if the problem asks me go cash to accrual, okay, you're going to do these the same every single time. You will start with the cash net income. Okay, and this is basically what we just did in the little example I gave you. We would start with the cash net income, and we would look at the current assets. And for current assets, I say do the same. In other words, if the current asset increase, add the increase to net income. So what happens? My account receivable went up. I added that to my cash net income to get the accrual net income, right? If they decrease, subtract that from net income. That's what I did in year 2. The accounts receivable went down 1,000 because I collected in that year, so I subtracted it. So if it's an asset, do the same. And you have to analyze current assets, current liabilities, and they'll give you those in the problem, and they want to see if you know what to do with them. Okay. For current liabilities, do the opposite. If the current liability increases, subtract the increase from net income. If the current liability decreases, add the decrease to net income. Do the opposite. Okay. They will give you depreciation in the questions. Always subtract depreciation. What happens? Depreciation doesn't use any cash. So for cash net income, what? Cash net income depreciation wouldn't affect it at all. Accrual net income, you have to subtract the depreciation. You see what I mean? That if you keep looking at this, the logic starts to get embedded and you start getting more and more comfortable with this. Okay, so you keep practicing with this flashcard. Add fixed asset purchases. Okay, what happens? They're going to have a fixed asset purchase. They're going to treat it as what? As an expense, but purchasing a fixed asset is not an expense for accrual, so you have to add it. If there's long-term borrowing, subtract that from net income to get accrual net income, cash net income to get accrual net income, because what? Borrowing doesn't generate revenue, but under cash basis, you borrowed some cash, they're going to treat that as though it were a revenue. Okay. So again, this is how you're going to do every single one of these problems. I want you to have this flashcard there when you're working these problems. If you got to peek at that flashcard, okay, but eventually you need to wean yourself off this flashcard. Okay, but this flashcard is going to work. Okay. Accrual to cash flashcard. And basically what? Start with accrual net income. And for assets, do the opposite. If they increase, subtract them. If they decrease, add them. For current liabilities, do the same. If they increase, add them. If they decrease, subtract them. Always add depreciation, right? Because now you've got accrual net income, consider depreciation expense, but it didn't use any cash. To get to cash net income, you have to add depreciation. Subtract fixed asset purchases, add long-term borrowing. So if you look at these, if you understand the first flashcard, for the second one, just do it in reverse of what I told you, okay? For the first flashcard. Now, in some problems, they ask about just say revenue, okay? That happens in some problems. If they ask you about just revenue, what you have to do is you follow the above rules, but you follow the above rules analyzing, and they'll give you information about the related accounts. So they'll give you information about accounts receivable. They'll give you information about unearned revenue. Those accounts are related to revenue. So you'll follow the same rules that we talked about above, but you're just going to probably deal with less accounts than accounts receivable and unearned revenue. And of course, you have to consider the cash, because they're gonna give you cash revenue, and that's the number you got to adjust to either accrual or cash revenue, or they'll give you the accrual revenue and you have to adjust it to cash. And if the problem is talking about expenses, basically reverse the above rules that I've talked about here if they just ask you about expenses, okay? Most of the questions you're going to see are just going to ask you about net income, okay? So this information that you see on this page, on this screen right now, is the way you answer the problem that is at the bottom of page 38. So I need you to go all the way to the bottom of page 38. Okay, and what we're going to do, if I can figure it out, is toggle back and forth between this set of information and the written analysis that you saw here in the Word file. Okay, so what happens? They're telling me here that they had cash basis income of 30,000, and they want me to tell them what should be what? The accrual basis. And I'm just going to do the net income, accrual basis net income here. Okay. So what happens? Well, I look at the current assets. I'm going to look at the current liabilities, and I'm going to see what I should do with those, right? So what happens? They tell me that the accounts receivable did what? It went up 5,000, right? Okay. So when I come back over to my flashcard, since that's an asset, I do the same. I add it, right? The 5,000. That's what the flashcard said. Do I need to go back to the flashcard for a second? For a current asset, do the same. If it increases, add it. Okay. The problem told me here that what? That the accounts receivable increased. They gave me the change. And a lot of times the problems will, you might have to calculate the change. It increased, so I added it. Prepaid insurance, is that an asset? Prepaid insurance is an asset. It did what? It increased, and so I go ahead and I look at the answer here, my solution that I wrote up following the rules. I add it. Okay. Now what happens? I have unearned revenue. Unearned revenue is a liability. It went down, and since it's a liability on my flashcard, I'm supposed to what? I'm supposed to do the opposite, right? So since it went down, I add it, okay? And then salaries was a liability, and that salaries did what? Let's just look back at the problem. Salaries went up. So since it's a liability, I do the opposite. Salaries payable went up. I do the opposite. I subtract it. And then I always do what? Always subtract depreciation, add equipment purchases. And, you know, I'm not going to go, well, okay, go back to the problem, John, right? Right there. Okay, the purchases, they tell me the purchase equipment is 5,000. And then I guess I have to calculate the depreciation here, guys. I'm not going to teach you right now how to calculate depreciation. I think you know how to do that. And so I went ahead. The key thing was once I had the depreciation, I had to remember to add, to subtract the depreciation, always subtract the depreciation. And when I did, I ended up with 52,000, which is the accrual. And I said revenue. It's the accrual what? Accrual income. Okay, which is what I was looking for here. All right. Okay, that's how you do those kinds of questions, guys. All right. Now let's take the last couple minutes we have, and I'm going to turn you loose on class question number 2 over here. Let's see how we can do on this. Okay. And if you need to I'll tell you what, how do you want to do this? You should be able to see the class question in your book. Can you? Can you guys see the class question in your book?
Yes.
But we
Okay.
need the flashcard.
So I'm going to leave the flashcard up. Yeah. Okay. So I'll show you the question I want you to work though, but let's go ahead and find my book. Page 40. Go to page 40 right here and see if you can work that question on page 40 using the flashcard that I will put up. There's probably some way of showing them both at the same time. It's just, I don't know how. So I'm going to assume you can see the class question, okay? Go ahead. We've got 1 minute left, so I'll give you 2 minutes.
We're converting accrual to cash, right?
We are converting accrual to cash in this question. Okay, so let me go ahead and maybe I should have wrote the answer on the question itself. So the rule says, the flashcard says what? If we're going from accrual to cash, you start with the accrual net income, which was what?
Okay.
100,000. Okay. Then the flashcard, just looking quickly back at that, says that what for a current asset, do the opposite. So they sit there and they tell me in that question that what happened, accounts receivable had increased. So since accounts receivable was a current asset, I do the opposite. I subtract it. And then the flashcard says for current liability, you do what? For a current liability on the flashcard, it says do the same. So since accounts receivable in that question, accounts payable in that question did what? Since it decreased, I do the same. I subtract it and I get the correct answer here, which is now what? My cash net income is what? 84,000, which was what the problem wanted. Okay, you got to practice with this thing, guys, but you got to get this down to where you are very, very efficient and very effective at getting through these questions. And you're going to see a bunch of these in your homework, okay? And it's important that you do this. This is a potential game changer for you. The examiners would love for you to get all tangled up in this stuff and blow your time budget on stuff like this. That's why you can't mess with it. You can't F with it. Don't sit there and play the game of trying to put together a whole year's worth of transactions to figure out what the heck happened here. That's not how you do this. You take that approach on those cards. You do that every single time consistently. You hone your method for getting through these questions, and this ends up being your ally on the exam as opposed to the enemy that it is for probably 90% of the CPA candidates. Okay? Question? Okay, good. We will quickly wrap up chapter 8, chapter 2. Next time, I'm mostly going to spend time going through the partnership discussion with you, and then we'll get into chapter 3 next time as well. Okay? Any question? All right, guys, good work. I will see you on Thursday. See what you can do about catching up with any homeworks from chapter 1. Well, you got to probably finish now chapter 1 because we finished it today, and see if you might be able to maybe knock out a couple of flashcards from chapter 2, and I'll see you on Thursday. All right, guys, keep up the good work.
Thank you.
Thanks.
Thank you. Bye-bye.